Hello, this video is intended to provide insight into the Greedometer strategic risk algorithm, and specifically an application of the Greedometer algorithm to several stock market crashes. Let's take a look at the somewhat famous crash of 2007-2009. Let's zero in on the middle here of 2007. So in July of 2007, the S&P 500 was setting a new all-time high, just marginally more than it did in the year 2000. It retested that same peak in October of 2007 within 1%. Now, if you were just paying attention to the stock market, all you saw was a new all-time high, buy the dips dip, and basically a retest of that high, and you probably were expecting more of the same. Now, however, if you were paying attention to the Greedometer strategic risk algorithm, at least that year, what you would have seen is a key climb through the 6,500 RPM threshold to 7,000, a bit of a dip, and more readings above 7,000 RPM in the spring and summer of 2007. And this is really what's key, is what we're about to get into here in terms of recognizing a stock market crash before it happens. In October, it was a retest of the July peak for the S&P 500. If you looked at the Greedometer, however, markedly lower readings here in October associated with this stock market peak versus in July. 72, 7,300 RPM on the Greedometer, 62, 6,300 or so here. This is the telltale sign of a warm-up to a stock market crash. The sequence would continue, the crash would continue until the Fed began trying to stop it with its QE1 program announced in the fall of 2008, and finally a double down or an enlargement of that effort in March of 2009, ultimately stopping that crash. It would have almost certainly continued had they not done that. In 2011, here's another application of the Greedometer sequence. Much the same sort of thing, wherein you see in July the S&P 500 retests within 1% what it did the peak before that, in this case in April 2011, a retest within 1%. And while this is happening, notice this level here and these levels here are substantially lower, okay, associated with this stock market peak, a substantially lower Greedometer readings versus these quite elevated readings here, around 7,300 RPM on the Greedometer. So, same thing in the stock market, big difference in the Greedometer. This is what you're looking for in terms of the warm-up or the telltale sign before a stock market collapse. Of course, well, what did happen that summer? A 20% drop in the S&P 500 intraday that summer. I think it was about 18 or 9% on a daily close. But that crash was stopped by more action by the Fed and a tag team effort with our friends at the ECB. Otherwise, it almost certainly would have continued quite a lot further. Another application of the Greedometer sequence, two of them actually, was seen in 2014. The first half of the year we had a sequence very mature, very well formed, and the second half of the year another sequence very mature, very well formed, until both of these sequences, and we'll look at the eighth one, these sequences were, as the other ones were, impacted by central banker actions. Whereas every single Greedometer sequence, and as of now in late 2014, this is the 9th sequence, every Greedometer sequence has been stopped by central banker actions or threats of actions in some cases, mostly actions. Sometimes a central bank action doesn't immediately truncate. Sometimes it doesn't truncate at all. It warps, if you will. It bends, it changes a Greedometer sequence. Let's look at what happened here. In the spring to early summer this year, 2014, we have a beautifully defined sequence, very smooth, very predictable. What we're seeing is a stock market peak in terms of the S&P 500 well into this sequence, and what would have been a retest of that stock market peak here within 1%, with noticeably lower Greedometer readings here, certainly versus here and versus here. This is the sign, what we're looking for. Had the Bundesbank not chimed in the last week of March of 2014, we would have seen a much bigger drop here, and we'll see that in another video that will follow about the mini Greedometer. But there was basically the Bundesbank in the last week of March said that it would later in that year allow the ECB to begin full-on QE, so long as basically every other trick in the book was done. So between this point and now, pretty much every other trick in the book has been done. But further back to here, this was a warping of the Greedometer sequence courtesy of the Bundesbank threat and a non-stop barrage of pounding the table of ECB more threats throughout April and May and June, and delivering on those threats in terms of more monetary policy goodies by the ECB that summer. So this sequence, the Greedometer sequence, was warped and eventually, and you can't see it here, but truncated or stopped only to initiate the next Greedometer sequence, the 9th. So let's look at that. Much the same, very smooth sequence, very mature sequence. Certainly by the time we get to this point, what are we seeing is here a new all-time high in the S&P 500. This peak would have been retested and should have been expected to have been retested here, and it was after this dip. And notice this level of 6,700 or so RPM on the Greedometer, far lower than 8,000, far lower than the 7,500 seeing here. Okay, even though the stock market levels are within 1.5% or so the same levels, much the same. There would have been a retest, and as I say, there was a retest of the S&P 500 here. This would have been the crash initiation point. You can't tell from the Greedometer sequence, but you can from the mini Greedometer, and we'll talk about that in the next video. So a warping here of the Greedometer sequence readings. This would have been deeper, and this would have bounced back smaller and then dropped deeper had there not been the Bank of Japan chime in here, and the People's Bank of China and the ECB threaten again 3 weeks later here, and another week or two later from the ECB again here. A non-stop barrage of central banker threats, warping what would happen to the Greedometer, and of course keeping the risk-on rally going. This would not have happened had all these intrusions by central bankers happened. So it's the job of the Greedometers, it's the job of both Greedometers to bake in the reactions to central bank actions. So several things, I suppose, can be seen from the Greedometer sequences. They provide an advance warning before a stock market crash, and they are also susceptible to being warped by central banker actions.